Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is actually June 8th. I'm recording for Friday, June 7th show, which I didn't do one yesterday, so I'm doing it today on Saturday. Today's episode, I want to review the ECB recent cut, and I want to look at S&P earnings from a historical perspective and give some insights on that. On Friday, I've been talking about this coming up for a long time, the big unemployment number, which ended up coming in at 4.0. So I was right in the sense of predicting that it was going to be higher than expected. Now, that got offset by the employment report being a lot more jobs than was expected, like a lot more. And so the way that works, to my understanding, is that the unemployment rate has to do with people that want to work that can't find it. And so, how can you have more jobs and at the same time higher unemployment rate? It doesn't really make sense. But the idea is that the number of people looking for jobs is expanding more than the number of people that are getting jobs. So, it ticked up from last month, and if you look at a longer term chart from the Fred website, the unemployment rate, you can see we bottomed in January 2023, and since then we've been going up higher, higher low, higher high, higher low, higher high, higher low, and then we are going to another higher high. So, this isn't showing. Well, now that I'm looking at it, it almost does look like it is actually curving up, right? So if it was going straight up, that would be less of a problem. You could expect it to go more down, but I'm still seeing the lows of here looking more like a curve. But, like I'm saying, this is my favorite indicator as far as potential recessions go, because before every single recession, people want jobs, they can't get them, and it explodes higher. Typically during a recession, whenever it's really spiking, that means it's a recession. People don't have enough money, they don't have enough work, companies are going bankrupt, chaos ensues. And so, I still believe that we're at that part of the cycle. I was going to say, if it had gone down to like 3.7 was the number I was looking for to be like, okay, no, actually people are looking for work, and they're getting work, and there's nothing really stopping the market here. But that's not what's going on. The unemployment rate is still going up, and until this pattern breaks, we are headed into a recession, in my opinion, or possibly a depression. Other data coming out from Friday's reports, the hourly wages went up higher than expected. This is month over month, so 0.4% annualized is a pretty high rate of inflation for hourly wages, and that is a little concerning as far as inflation goes. But yeah, so hourly wages, and then the year over year, so how are they compared to last year? They're up 4.1%. The expected was 3.9. So this is where the stickiness of inflation is still showing up. We're not seeing disinflation here, which I'm surprised at. But then again, I think I discount a little too much maybe what Lynn Alden's been talking about for a while as far as fiscal spending goes, is how much money, once you inject a certain amount of money, it sloshes around until it's done sloshing around and things normalize. And we're not there yet in terms of where inflation is at this point. And so as obviously with the Fed funds futures, that got pushed out. The first cut is now not until September, I believe. Before it was 1 month earlier. Now it's predicting, pushing it out another month. And this has been going on for a while now. The market's been predicting, there's a cut coming, and they keep pushing it out, pushing it out, and eventually it pretty much will happen. And that's why I want to going to the ECB cut. So what's going on in Europe right now with their central bank? So let's start there. It was reported only a day or two ago. These are the rates in Europe, and so their central bank it was just a few days, like a day or two ago, where they did their first 0.25 25 basis point cut. This is a big deal. This is they go through the same cycles as we do. When you have your first cut, you tend to lead to more and more cuts. You're in your raising cycle, and then once the cuts come, it's typically forced and everything's falling apart. And so this is, we haven't seen a cut in this cycle yet, and this is the first cut here. So this is a big deal, and it's pretty inevitable for the United States to follow. The next important data coming out for the U.S. is next week is the CPI on Wednesday, and Thursday the PPI, which can give us more data as far as what's going on with inflation. Next, I want to take a look at the S&P 500 on a daily time frame. As you can see, it's quite a doji pattern. This is like a fighting pattern. This does have the potential to be a top here. This is definitely not very bullish, and it is not very bearish, but it's teetering, and so we don't know what's going to happen next. Are we going to consolidate and break out higher, or break down? A big part of where we're going to be going in the S&P 500 overall has a lot to do with earnings. Michael Burry, it was like a year and a half ago, I think he was calling for, the next part of the cycle being earnings contraction, and we did see that. I'm going to pull up that chart. I'll just do it now. So from macrotrends.net, they have a really nice chart showing the blue line is the price of the S&P 500, and the orange line is the earnings per share. So how much money each share of the S&P 500 earned. And when companies are earning less, in other words, the earnings is the money left over of the money coming in after they're done paying for all of their expenses, basically. And so when this is contracting, when companies can earn less money, it automatically kind of makes the value of stocks lower, and so the stock market almost always follows the earnings contraction period. And so if you can figure out when earnings are contracting, you can pretty surely predict that the S&P 500 is going to be following it downwards. As you can see, earnings contraction, we have the S&P 500 2015. It didn't exactly go very far down, but it did go down during that period. And then this chart actually scrolls out pretty further. So let's do that real quick. So you can see more recessions. Again, the gray bars are the recessions. And so, you have your earnings contraction. Sorry, this is a little hard to see. In 2000, companies are earning less money, and the stock market falls. And then earnings explode higher. The value of the S&P 500 goes up. Earnings contraction, the value goes down. So when companies earn less money, it only makes sense for businesses to the cost of purchasing a business, which is what you're doing when you're buying a stock, for that to go lower. So what's been going on very much more recently? So as you can see, this current view of the chart goes back to 2020. We had earnings per share at $100 per share of the S&P 500 in 2020. And we exploded all the way up to a high of 197 in the end of 2021, beginning of 22. And then that's also when we saw a peak in the price of the S&P 500. And then as earnings went down and contracted, the value of the S&P 500 went down with it, as it naturally pretty much always does. Now, notably, earnings grew from December of 2022 to January 2023, you can see it going up right there, and then the price of the stocks go up, and so and the price went down, but the earnings went up, and so we went higher. It's almost like here we had a flat period of earnings, and the value of the stocks kind of was scared that this might have been the top, and then instead it jumped up even higher. Now, where are we right now? Well, we've been flat for a pretty long time. Ever since October of 2023, we've been basically around 192, 191, and we have not gone up since then. And so the real question is this going to be trending down or not? Notably, from the end of 2021, we have never gotten to this height of earnings per share since that date, and yet the price of the S&P 500 is higher than it was back in the end of 2021. And so, the stock market is definitely getting ahead of itself, predicting that earnings will continue to expand here. And if they don't, if they go down, if they start breaking down lower and lower and lower, it will likely make the price of the S&P 500 to go down even more dramatically because of its error in pricing higher, all while earnings are actually currently lower. Moving on to some more charts and views of charts. This is the S&P 500 because it's the weekend, end of the week. I like to take a look at the weekly time frame, each candle representing 1 week of the price of the S&P 500. And this is not looking very bullish to me, and it's not looking very bearish. We might, I don't even have to open the RSI to know what's going on here. It's definitely overbought and not embedded. So when you're overbought and it stays overbought and it keeps showing strength, then that usually means it can, and it will just keep pushing it higher until who knows when, kind of a thing. But instead, it's simply showing that we're overbought, and when we're overbought, it's actually more likely for it to go back to longer term average. One of them is, people use different numbers, but 18 candle, 18 week average would be a normal place to go back to from here. My expectation, I believe it's more likely, no matter what, for the S&P to cool off here a little bit. Gareth Soloway, on one of his shows that I watched very recently, has mentioned how, good news. He said he believes we are in a period now where good news is considered good news and bad news is considered bad news. And the jobs being so strong and not seeing unemployment tick up too crazily high yet, which I think is, I don't know, we really got to see what happens Monday, because Friday, it's one thing for the market to initially react, and then there's this whole weekend to digest, and then we'll really see the effect of this Friday report, especially on Monday, and what follows. But, before, the narrative was kind of like, oh, if jobs are really strong, that means inflation is more of a problem, and therefore, there's not going to cut as much, and that's bad news. But the market's taking, as far as Friday's initial reaction went, seemed it was positive news. This certainly, if it was bad news, we would see a spike in the VIX, in the pricing of options contracts. Instead, we're going down here once again. So just a little bit of a cool off period, like a little bit of a relief that, like, everything's okay, everything's a-okay. Again, I'm getting more of a sense this is a calm before the storm kind of a scenario, but we'll see. I continue to be amazed by the resiliency of the markets, especially with HYT, high yield corporate. I will note that this is coiling up pretty tight right here. And when we have something getting tighter and tighter within a range, typically you get a larger, the breakout ends up being larger and larger the longer you go sideways here. And so I do feel like this is preparing for a bigger move. And again, I think there deserves to be more fear here than what we're seeing priced into HYT and the S&P 500 and in the VIX. I think they're all wrong, but again, we'll see. I mentioned at the beginning of the show the Fed funds futures being pushed out to September, and as you can see, we have it's pushed out to November, I guess, before we see a cut. So the September meeting is now predicting no cut. So that's what changed. So we had 32% chance of not cutting basically in September, and it was 51% chance of not cutting. So it grew from 32 to 51 on Friday. So it's saying nope, no cut in September. And same you see the opposite in the probabilities of the cut. So we were at 55% chance of being a cut, dropping to 45%, and then finally now we're pricing no cut until November in the Fed funds futures. One thing I need to remind myself is that all of these probabilities, just because they're priced in, it doesn't mean that it's going to happen. I mean, it pretty much does mean it's going to happen within like a month. Like the Fed funds futures is pretty good at predicting what's going to happen at the very next meeting. It's almost never 50-50. It almost always is like 99% chance this is what's going to happen, and the Fed pretty much always does what it predicts. The Fed, the way they talk is they try to guide the Fed funds futures to accurately like show what they want to have happen, basically, and so they force each other to work with each other. It's pretty much how that works. A chart that I just noticed very recently that goes against my own positioning and my own narrative, that kind of scares me a little bit, is the 10-year note yield here. If you zoom out, this chart where you see it right now goes back to 2005, and if you start in 2016 with a 10-year note yield, what do we see right here? Could this be a head and shoulders? I don't know if we can count that as the neckline or this is the neckline, but is this going to turn into a head and shoulders? And if so, we might expect rates to go up as high as almost 10%, somewhere around that range, which this chart alone allows me to be thinking like, okay, if rates do go down especially in the short term, as I fully expect them to do so, maybe it's not time to be hoggish here. Maybe it's time to be piggish and just get out of that position. The cash is not trash. The money market yield is higher than inflation, and there's no problem with having cash sit in there still right now. To do anything else is just you're taking on risk that it's just I don't know. Then again, you don't get any reward if you don't take any risk. Last chart I want to point out, the TYX, the 30-year Treasury yield. This one, notably from this trend line that we've been hitting 1, 2, 3, 4, and on the 5th we broke it. And so now, because we've hit it so many times and we're on the other side of it, this becomes a major resistance point. And so we hit it. We basically hit that line on Friday, and my expectation is to be again going down from here. Gareth Soloway on his show says his target now is 3.9% on the 10-year, and so and so that's sort of my target for getting out at this point for long duration bonds, unless this stock market is just collapsing and this thing and rates just keep on dropping. I mean, at that point you can get out at any point. You'll never see rates jump up like an entire percent in a day or a week. All of this takes time, and so there's time to be patient once that target is reached for anybody else that's trying to take advantage of potential lower interest rates moving forward. That's all I have for you for today's show. I hope you enjoyed, and thank you for watching. Robschild.